Stock markets rely on the Federal Reserve and their actions. So far, we've seen low interest rates. In fact, they're at 0%, and we have seen the quantitative easing that has gone into the trillions of dollars. This has allowed these stock markets to advance around the world. But with the fear that they are pulling out of these schemes, the stock market has been quite volatile recently, and I will show you specifically what nobody else seems to be covering for some strange reason, that the stock market is directly linked to the Fed's balance sheet. You came here for the truth. I will unveil that to you right now. Let's go into this. This is the chart right here showing you the Federal Reserve assets versus the S&P 500 index. It is practically chasing the values. You could see this right here, the S&P being the red and the Federal Reserve being the blue. You could see it's practically going in the exact same direction. When one is up, the other is up, and the other is down, the other is down. This goes into these statistics right here, showing you the truth about how this works. The Federal Reserve goes into the market and they buy up bonds. They're buying up the debt of the government. This somehow is translating into increased stock prices. Now, where the analysts and where the individuals are wrong, they suspect that this is because the economy is now fine. It's stimulating the economy. All this has done is devalued the dollars, so things are rising in their nominal value. Yes, food is increasing in its nominal value, electricity, but are you getting better service? Are you getting better food? No, it's just the same things, the same items. That carrot is still a carrot, but that carrot costs more dollars to buy because there are more dollars out there. That is what inflation is, the increase in the money supply and the effect of which is rising prices. That's how this works. The Federal Reserve's balance sheet directly linked to the S&P. The S&P is not any more valuable than it was a few years ago, but there's just more devalued dollars printed in. That is the big news for today. I've shown this chart before, and this is actually quite telling here. You could see in between QE2 and QE3, there's no growth. You could see it's up and down, up and down. And as soon as they say, okay, we're going to print money, don't worry, the MSCI World Stock just goes up. And then that point at which it's being volatile again is where they're talking about removing the QE. As soon as they started removing their QE from $85 billion, the stock started to become volatile. That's what we need to be concerned about, because we ultimately know what's going to happen here. If the Federal Reserve pulls out, we're going to have, at the very best, and that's with 0% interest rates, we're going to have no growth. Now, if they start increasing the interest rates, you know exactly where that stock market is going. Let's go into the more details here. Goldman Sachs has a startling forecast for the euro. Now, this is huge news. I don't know. I mean, I've seen a lot of analysts predicting this for quite some time. If I just scroll down briefly for a moment here, it says this: we expect the downward gravitational pull on the Euro USD will persist for the next several years until it trades at parity versus the dollar by the end of 2017. That is a huge, huge change that will occur if Goldman Sachs is correct, and they will hit parity. That's going to be a huge, real spine or thorn in the side of the euro, because they really relied on that strong currency. Of course, that may make them better for exports, but ultimately there are bigger things going on here. And also, this is factoring in the fact that the US dollar continues its strength. Now, the US dollar does have certain advantages. It is the reserve currency of the world for the time being. So a lot of that, though, could be a problem, because, of course, strong dollar means really the slower exports, and that's a big concern for the US. But, of course, year after year, they're exporting less and less as they really send that out to China, factories in China and stuff. This is the European Financial Stability Facility, or Fund, as it's often referred to as EFSF. Now, this right here is going to protect the Eurozone. That's what they suggested back in 2010 when they initially put this into effect. They said that if we allow this to occur, the EFSF, we are going to protect everything. There's going to be no problems, and the whole European area is going to be once again stable. Because, of course, that's the European Financial Stability Facility, and that is absolutely not what has happened so far. I talked about it in my book, knowing what was going to happen. And this right here, it says basically the establishment of the IMF in 1945 and more recently the EFSF, Financial Stability Facility Fund, in 2010. None of these organizations were capable of preventing crashes and instead distort the market and burden the taxpayer further. The EFSF and any new organizations that are created will not defy what is laid out in the pages of history. Now, what I said with that, this is prior to the ESM being introduced. I'll go into that right away. The European Stability Mechanism. See, I knew that was coming in. It hadn't officially launched at the time of writing my book. However, they talked about this and how this would basically mean a real loss of sovereignty of many nations as they forced them economically to join these sort of things, the ESM. Basically, I'll read the first line. It says, the ESM is authorized to make use of the following lending instruments to benefit its members subject to the appropriate conditionality. And it says it's going to provide loans and so on. So what exactly is this all about? It's basically a way for them to take money from the average citizen, put austerity measures into place, and have them strangled for the remainder of their lives. That has been working quite well, I would have to say, but of course, for the economy, it's not doing a single thing, and we've seen that statistically and historically. As this crisis continues, Europe is doing much worse than it was, and this is just going to continue to go downhill as the contagion spreads throughout Europe, throughout the whole world. You can see how China has been slowing down. I showed you a few videos back, 9 charts showing you a decline in China's economy over the past few months. The US obviously in big turmoil. You have Canada, which is a really big issue because they export a lot to the US. They're exporting to other nations, and of course, if those nations are doing slow on their own, they're going to have a big problem. You have Canada's real estate values that are the most overvalued in the entire world based on income versus housing prices. And then you look at a country like Australia, and just want to pop in right here and just say, Australia, I'm making a video for all the Australians out there. Have no fear. I've been collecting data. Stay tuned for that one. But they have their own problems as well, but they are a little bit buffered, I will say, because they're dealing with, a lot of the times they're dealing with Asia, that allows them to be buffered from what's happening in the West, but they certainly will be one of the dominoes to fall, I assure you on that. So let's get into this right here. Bank of China denies report alleging money laundering aid. This is out of Bloomberg, but I didn't really want to get into the money laundering part. What I was saying was, basically the fact that they are now allowed to take money out of the country beyond the small ration that they normally would be if they were to invest in property. So this has been allowing them to basically funnel their money out of China, and they are rapidly doing so, and you can see that in this article here. Why are the Chinese millionaires buying mansions in an LA suburb? You can read the article for yourself, but essentially what it's talking about was they are buying up these homes like crazy all across the US. And there's one area here where 90% of the buyers are Chinese, right from China. They have this money, they're able to get it out of their country, and they're buying something that may be sitting empty for most of the year. And they're basically looking for alternate investments outside of their own country, and they're choosing US real estate because oftentimes in certain areas it has declined rapidly, so they want to buy up some homes, and they're doing so. I got into how recently that a Chinese company was actually allowed to get free land from the city if they bought in, put their factory there. There's a lot of things that are going on right now where you have foreigners buying up more land than actually the own people there, because the people can't afford it. In fact, right now, statistically, we're looking at a lot more people selling their homes and going into renting. That's another statistic I've been looking at recently, and this is obviously a big problem. because during the subprime mortgage, you had people moving out of renting and then they were buying up the homes, the subprime homes. And then when the financial crisis came about, you had them selling those properties or just walking away from them because they put no money down anyway. They just handed in the keys and then they began renting again. So we could see that and use those as statistics to judge the real economic factors. We know we're not going to get the government statistics that are accurate. So we use our own statistics. And one of those being how many people are renting versus how many people are buying. Look at how many loans are being given out. There are all sorts of statistics that I talk about actually in the back of my book. I have this thing called the Resource Corner, which goes into all of that and basically defines, all the statistics you should be looking at to give you a good idea, not necessarily the unemployment rate or inflation rates. So what I wanted to address here in this video was showing you that the stock market is directly linked with the Federal Reserve's balance sheet. We see them, they're about to pull out. What's going to happen? Well, we're going to see a crash. That crash is going to create a domino effect across the world and undoubtedly bringing more problems. We cannot face these problems right now. They're going to have to engage in a QE4 scheme or just ramp up QE3 once again, keep the interest rates low, or they could decide, however, I don't think this is going to happen right now, to raise the interest rates dramatically, crash the whole economy, have the billionaires and trillionaires take their money, pop it into the system and buy up everything for pennies on the dollar. They've done this before. You've heard about it historically, with the Rothschilds being one of them that have done this. And that's it for today's news. I've rambled on long enough. I hope that you are enjoying these videos. If you do, please give me a thumbs up. It really helps me out a lot. Signals to the other YouTubers out there. And basically what I wanted to say is that this YouTube channel will remain free. There will be no charges on this YouTube channel. There will be no way for you to become a member to this. This is free information, and I hope that you enjoy it. I hope that you enjoy the work that I'm doing here and that you will share this with your friends and family. If you don't want to share my video, create your own video and share that, because what's really important is the information, and the information is being really clouded from us, being shielded from us, and we need to break through that, and we need to realize that, look, something's going on here in the system and nothing is right, and we have to be protected. And the way we do that is with information we learn. We protect ourselves and our families. Please give me a thumbs up on this video, be a subscriber to the YouTube channel, and it is very important to become an insider if you're not already. The Insiders is where I give out all my best intel for free, and that is available at themoneygps.com. You scroll down to the bottom, fill in your email address, and you get occasional emails from me with good, short, concise info.